HVAC Ladder Podcast, Episode 14, Proactive Tax Planning. J.R. Lawhorn here, and welcome to another episode of the HVAC Ladder Podcast, a podcast devoted to helping you take the next step in your HVAC career or business. It doesn't matter if you're brand new to HVAC or you've been in it forever. There's something you can do to take the next step. You can find the show notes of this episode at hvacladder.com/14. That's the number 14. Today I'm interviewing Cody, a tax coach and CPA who professionally helps businesses like yours and mine to develop proactive measures to save money on their taxes. You can find all his contact information on the show notes for today's episode. Craig, welcome to the show. I appreciate you coming on today to help with a huge topic. I've run my own business for almost 10 years now, and taxes are one of my biggest pains. Just the thought of having to spend about 40% of what I earn, sending that money directly to the government, that's probably the biggest heartbreak of running my own business. And Craig is going to share with us today some strategies on how to minimize that tax. And we're not talking about breaking the law. We're just trying to use the tax code as advantageously as possible without breaking the law. No shady stuff here. So welcome, Craig. Could you tell us a little bit about yourself?
Sure. Thank you very much for having me. I'm real psyched to be here. Well, I'm a certified public accountant, CPA. I'm also a certified tax coach. I'm a business owner. I am a former New York City police lieutenant. I've been doing accounting now for about 18 years. As a certified tax coach, I belong to a select group of tax professionals that go to advanced and extensive training for about 5 to 10 days a year. I've co-authored a Amazon bestseller, Secrets of a Tax-Free Life, and my most recent book is called The 10 Most Expensive Tax Mistakes That Cost Business Owners Thousands. So I'm excited to be here and share.
I'm excited to have you on because I always, sometimes I'll try to attack a finance question or a tax question and have to leave the caveat, I am not a CPA and I am not an attorney. So I'm glad you could come on and talk about these topics, and we'll get the expert opinion directly from the expert. So the first question I've got for you today, Craig, is what is proactive tax planning and how can it minimize what we pay in taxes as business owners?
So what proactive tax planning is, most people are used to what we call reactive tax planning, which is kind of looking in the rearview mirror. They meet with their accountant or their CPA maybe in February, March, or April, and he's basically just recording history. He's not making history. When you're being proactive, you're actually making history. You're looking for the legal ways, your clients can legally reduce their tax bill by proper planning, which is communicating and figuring out, I'm doing this, I'm doing that. Maybe if I do it a little bit differently, it could be deductible to me. That's what proactive tax planning is.
I know with my CPA, it's, I manage all my books, put them in QuickBooks, send my CPA a file after the end of the year, and they prepare my taxes. So it's completely the opposite of that. So I should probably be meeting with my CPA a few times a year. Is that what you're saying?
Yes, you should definitely be meeting and communicating with them. You don't necessarily have to meet in person, but you should definitely communicate. We like to communicate with our clients at least once a month, and we typically do like a WebEx or a Zoom call with them. Everyone doesn't have to set aside a whole bunch of time, but we could go over the P&L, we could see what they're doing, and we could give them any ideas or strategies that they should start doing. And we should also make sure that they're implementing the strategies that we've already talked about to save them money.
With the clients you've worked with, what have you seen that you would consider the biggest mistakes that folks make, other than not proactively planning?
Well, right. The first one is failing to plan. People just, they look at accounting and tax prep as a cost item instead of an income item. So they just kind of fail. Then the next thing is typically choosing the wrong business entity to operate your business out of. It's like, what planning went into choosing that entity? Are you an LLC? Are you a corporation? Are you an S corporation? Why'd you make that decision? And depending on your particular facts and circumstances, an LLC might be the right way to go, or an S corporation might be to go. So that's typically not planned for. Typically, they speak with their attorney, And he says, well, I like LLCs for asset protection, which is great. Okay. But let's take the legal part and the accounting part and figure out what works best for you. So that would probably be the second biggest mistake, picking the wrong business entity.
So my audience is mostly service businesses. So they've got, they've got service trucks, they've got tools. In some cases, the employees own much of the tools. Typically, the business owns the vehicles. Do most of those folks go LLC, or do they do S Corp? Or
it honestly, it's a little bit more in depth than that. So you'd really have to see what the owner's situation is to see what makes, how much money he's making, what other things does he have going on in his life, and then you make that decision, because me and you could be in the same exact business,
right?
Excuse me, and an LLC may work for me, but an S Corp might work for you, or maybe someone else. A sole proprietor is the way to go. So you really have to figure that out. And each of those entities also has different benefits that you're allowed to deduct. So that plays into it also. So
right. Now, if you start, let's say you start as an LLC and you're working with your CPA, and you eventually decide, hey, this is we're moving into territory. Maybe you start out small, and it's more advantageous later on to be a corporation or an S Corp. I'm assuming that can happen, right? You don't have to.
Yes, you can make an election to be treated as an S Corp. And normally that has to be made by March 15th to be retroactive to the first of the year. But there are certain situations where the government will allow you to make a late election.
Okay.
So, and that sometimes can be very advantageous, depending on, once again, your facts and circumstances.
Yeah. So what are the most expensive tax mistakes that the businesses make?
Well, let's talk about a simple one that may not sound so simple, the home office deduction. Do you have a place that you work out of, or do you work out of your home, or do you have a main office that you work out of, but maybe you spend another 12 or 14 hours a week working out of your home office? And, that used to be, taboo. You can't write off a home office. That's going to be trigger a red flag or an audit. That's definitely not true. All right.
Okay.
The IRS actually came out with a safe harbor number there. So that's not true. So you should have a home office if you work 12 to 14 hours a week out of your home. And it's not so much the deduction that you get from writing off that portion of your home that's used exclusively for your business, but it's the things that then opens up for you to write off. So let's just say you have that home office. Now you could have a home athletic facility, okay? And it has to be for the use of your employees, their families. So maybe that's your pool, okay? Or maybe that's your home gym. Now you could write, yes, that's a big one.
Nice.
Now you have your travel becomes deductible from your home office to your other office. So what you may have considered in the past a commute is really not a commute, because you're going from one office to another.
Right.
Medical benefits. All right. Most of us out there have health insurance, but what are our out-of-pocket costs? And can we institute what we call a medical expense reimbursement plan, where, the kids need braces. That's going to cost us, somewhere between $4,000 and $8,000 for a set of braces per kid. Is there a way to write that off legally? Because if we take it on Schedule A, we really don't get the benefit of it. So maybe we qualify for what we call a medical expense reimbursement plan. So those are a couple of small ones.
Mm-hmm. Yeah, and I'd always heard that the home office is it's an audit flag. And that's probably, as a small business owner myself for probably about 10 years now, that is the last thing I want. and right. I think it was before I hit record that I was talking about my CPA is really conservative. He is not about to push the tax code, and he leans on the side of not being audited. And I guess it makes sense for a consulting CPA if you're just, you're doing someone's business taxes and they pay you a flat fee each year to do that. It's just nice if you never get any of your clients audited, and that way you don't have to get involved and there's no hard feelings. But it could also, push you into losing a lot of money if you're not using the tax code to your advantage.
Right. And if you're doing it right, let them audit you. If you're doing it wrong, you don't want to be audited.
Yeah.
But, so we do it right. We document everything that we do. We document everything that the client's doing. So if the client was to get audited, that's okay, because we have the documentation to support what we're doing.
Right. Now, if you do get audited, and I'm assuming you've been through this process, certainly that's going to take time for the business owner away from their business. Now, let's say you get audited. Is there a way for that business owner to be compensated for that interruption, kind of like a false audit, or is that just kind of built in? You just kind of have to.
Are you talking about the government compensating you?
Yes, or
yeah, that's
no.
No, that's not going to happen. And I mean, honestly, if you're being audited, you should have a professional representing you.
Right.
So you should be running your business and let the professional handle the audit.
Right. Now, so if you're in that situation, and I think my CPA, the guy that does my taxes each year, I think there's a disclaimer in my agreement with him that he does not audit my books, and that I think it kind of really just protects him. And I'm not sure that. I think since I've been doing business with him for as long as I've been in business, I think he would help me if I got audited. But I'm not sure that he's contractually obligated to help me. I mean, I guess I would have to go and pay him more money.
Right. I mean, that would typically be, if you're being represented in an audit, in an actual full-blown audit, that's going to cost you more money. But, most often it's not a full-blown audit unless you're doing something,
very shady.
Yeah. Normally you'll get a notice. They may ask for something, stuff like that.
Right.
And with our clients, because we work with our clients year round, we deal with all the communications from the various, federal and state and local agencies. So they could work on their business, make their money, and we handle the compliance side and the planning side.
Okay. Now, when you do that for your clients, is it under kind of like retainer, like you would retain an attorney for services, or how do you handle that?
After we do a tax, in order to be a client of ours, you have to go through and have a tax plan first. And a tax plan is typically going to save somebody somewhere between $60,000 and $20,000 a year. That's the kind of goal to make it worthwhile. And then at that point, if they want to work with us going forward, they can work with us going forward. Everybody's on a monthly retainer. And we work with them throughout the year.
And do you so you do the tax plan and kind of show them the money that they're wasting, sending to the government, potentially, and then go from there, whether it makes sense for them to engage you to save,
Correct. To engage us to do a tax plan to show them actually how to save it and then implement it with them. And then about a third of those clients say they want to work with us going forward, and they can take that plan back to their current CPA and work with them.
Okay.
Yeah.
Interesting.
Yeah, it's typically the client has got somewhere between a 400% and 600% first year ROI on that investment, so it's normally it's a good deal for them.
Oh yeah. So I think most of my audience, there are some that have larger businesses that are operating from an office or from a shop, but I think for the most part, the majority are working from a home office. So. In those cases, I think that's probably a huge takeaway, and certainly for me, because I run my own business and I work from home, but I've never claimed the home office credit because I always thought it was a red flag for auditing. What do I need to do in this specific case to claim a home office? What do I need to do? And I think this is also something we talked about before I hit record, to have a defensible position, I think is how you put it. For the IRS, if they come asking questions, what type of documents do I need? Let's say I'm using a spare bedroom or a certain space for my home office at home.
Well, the space has to be, solely for your home office. So it can't be the spare bedroom that, people are using.
Oh, okay.
It has to be, specifically for your home office, used exclusively.
Okay.
So there's a lot of space in the house where people can do that, whether it's a section of their basement,
right.
It's a spare room, it could be the garage, that they just use for their office.
Okay.
And we tell clients, take pictures, all right?
Mm-hmm.
Take pictures, and just keep good records.
Right. So,
and then let's just say that space takes up 5% of your square footage of your home. Mm-hmm. So now you get to write off 5% of your home expenses.
So that's utilities, that's everything.
That's real estate taxes, mortgage interest, and then we say, well, I'm already deducting my real estate taxes. I'm already deducting my mortgage interest, but that's the way it works. So you get to take that there. If you're subject to AMT, it helps a little bit there, but you have to do it the right way, and document what you're doing, what you did.
Okay. So in my case, right now I'm working mostly from a spare bedroom, but I have an unfinished basement that I could, take a portion of and make it into an office. But let's say, my basement is roughly a third of the square footage of my house. It's a 2-story home with a full unfinished basement. But let's say it were 25%. Let's say I finished most of my basement and used it as an office, and it became 25%. Is there a certain percentage of the square footage of your home that they're looking at to?
No, but if you actually take your basement and then you finish it to create an office, you document all that,
Okay.
because most people aren't going to spend what it's going to cost them to finish half of their basement to get a home office deduction.
Right.
So if you're doing it because you actually need the space.
Okay. And so you're saying it may not make sense to do it
Well, from a financial, it's kind of like you don't buy a piece of equipment just to buy a piece of equipment to get a deduction.
Right.
You buy it because you need it, because would I rather have the money in my pocket or give a percentage of that money to the government?
Right.
I'd rather have it in my pocket. So you don't want to create extra expenses. You just want to, if you need the space, then you build it out. But if you don't need all that space, why would you spend the money to build all that out?
Right. Well, I guess right now I'm working from a spare bedroom. So
right, but what I'm saying is you don't have to do half of your basement. You
That's
could
true.
do 200 square foot or something like that, which is gives you more room.
Plenty
Stuff
of
like
space.
that.
Yeah.
Exactly. So you don't want to just spend money to get a tax deduction. You want to keep, the whole idea is keeping more of what you make. And if you're laying it out just to get a tax deduction, that's not a good strategy.
Right. Sounds good. So here's another question. Some companies, and this is a question that often comes up in this in the HVAC trade, some companies, some businesses provide some tools for their technicians, and some don't. Some require their technicians to provide all the tools. And the theory behind that, in large part, I think most companies require their technicians to provide their own hand tools. The idea is that they'll take better care of them.
Yep.
Are there any tax differences? So you're taxed, I guess, a little differently. I guess as the individual technician, they can deduct those tools that they are required to provide for themselves. They can deduct those from their individual taxes, I guess, kind of like a uniform or something like that.
Correct. And those are subject to, basically if that person's making, let's keep it simple, $100,000, the first $2,000 is non-deductible.
Okay.
So the employee typically doesn't get the same benefit that the employer would get from purchasing the tool.
Right. So in that case, even though they'll take better care of them, if they purchase them themselves, it's actually less advantageous for them to do that than the company to provide them.
Right. But it's kind of like a cost of doing business for the technician if he wants to be in that field,
Yeah.
he needs to have his own tools.
That's right. Some of them will provide the more expensive tools, 2 or 3 things maybe. But
Right.
Anything around transportation, vehicles, company owned?
Well, your vehicle expenses, if they're company trucks and they're used exclusively for business, you should be writing them off, depreciating them the correct way. Repairs and maintenance, that stuff is all deductible.
Okay. Sounds great.
Then you have your meals and entertainment. As the business owner, when you're entertaining or taking clients out or potential clients out, you get to deduct 50% of that cost because the government says, well, you had to eat anyway. So that
Right.
part should not be deductible.
True.
And it's really just a matter of keeping accurate records, and that could just be using one credit card to keep all your business expenses on.
Mm-hmm. Now, that's a great question. That's a great topic. Is that enough? Is that enough documentation? Let's say you are deducting things like meals and entertainment. Is that credit card statement enough for the government?
No, it's not. It's part of it, but
Okay.
you should also have your calendar with who you had lunch with,
Okay.
or dinner with.
And receipts.
Yeah, well, typically the receipt you could always get from the credit card down the road if you need it.
Okay.
I tell client if you have the receipt, stick it in an envelope, keep it near your front door somewhere, and just stick them all in there. If you ever need them, they're there.
Mm-hmm.
But the main thing is if it's documented on the credit card and you have it also documented in your calendar or your phone where you were that day,
and who you met with, and
exactly.
Yeah. Okay, sounds good. Well, Craig, this has been great. So tell me a little bit about your book, The Secrets of a Tax-Free Life, and where folks can get that.
Well, that book is actually available on Amazon, but my most recent book, The 10 Most Expensive Tax Mistakes That Cost Business Owners Thousands, which is a mouthful, is available. We're going to give you a link for your show notes, which is craigcodyandcompany.com/HVAC. And if they go to that page, they could fill out a form, and we will send them a paper copy of our book.
Okay, and I will make a little easy link in the show notes, absolutely, for that.
Perfect.
Let's see. So it's Craig, Cody, and company.com. Let's make sure I can get there first. And is spelled out, I'm sure.
Yes. //
HVAC.
And then they could reach me via email at craig@ccodycpa.com or the office number here,
okay,
which is 516-869-4051.
All right, so those are all the ways they can get in touch with you. And what should they expect if they? So they should get in touch with you if they are looking for tax advice or a second opinion, maybe on what they've been doing with their own CPA, or what is that first meeting with you going to look like?
Well, the first meeting is if they want to keep more of what they make, and the first meeting is a conversation we have. They kind of give me some background. It's a 5-10 minute call. We go over some stuff. Then, if we think it's worthwhile for them to move forward, we typically have clients send us copies of the last year or last 2 years tax returns and maybe a current P&L via a secure share file. Then we do an analysis, and we set up a WebEx where we go through the analysis with them and say, okay, we found X amount of dollars in savings for you.
Okay.
If you want to go forward, we can do a tax plan. Our tax plans are 100% refundable. I've been doing them for 6 years, and no one's ever asked for their money back because they're just instant gratification.
Oh, yeah. So what is that? I mean, just for, is it scaled to the size of the business, the tax plan, or is it flat?
It's a flat fee, but it depends on the actual plan, what's involved in it for us.
Mm-hmm.
All right. So, and like I said, usually the first year ROI, to make it worthwhile for the client, I want it to be at least around 400% first year ROI.
Sure.
So somebody that put down money this month, okay, we'd want them to be able to realize savings in 2017 of like 4 times what it cost them.
Absolutely. That is business value right there.
Yes. Hey, if the broker called them up and said, I have a guaranteed 400% return on your money. That's
right.
Here's the credit card.
They would not believe it, first of all.
Right. Exactly.
But well, Craig, I really appreciate you coming on and talking about this. This is a tough topic because it's so complex. The tax code in the United States and sometimes in the States can be super complicated and complex. And if the business owner feels like I do, it always feels like the companies that have a little bit of scale that can afford to pay consultants a little more always come out ahead. And so there's kind of this maybe a glass ceiling, if you will, for a small business owner to try to really maximize what they save on taxes.
Exactly. And the key to that is communication. If you're not communicating with your professional, the doctor doesn't call you up and say, how are you feeling today?
That's right. That's true.
So you need to communicate with your CPA, and hopefully he'll communicate with you. And, you want to see, keep more of what you make.
Right. Beat them up for that information.
Exactly. They should want to give you that information.
Sure. Okay? Absolutely. All right, Craig. Well, thank you for coming on. I really appreciate it.
Well, thank you so much for having me. It was great.
You can find all of Craig's contact information in the show notes to today's episode at hvacladder.com/14. That's the number 14. That wraps up another episode of the HVAC Ladder podcast. For past episode tips and advice, check out hvacladder.com. If you enjoyed the episode and think more people like you should listen, take a minute to submit a review on iTunes or Stitcher. If you go over to hvacladder.com and click on the resources page, there's a quick 6-minute video there that'll show you how to do that on the Podcasts app if you're using an iPhone or an iPad. The strategy for this episode is all about tax planning. The advice is to call your CPA and just fill them in on where you are in your business and what you're doing in life and family, and see if they have ideas for you as far as saving money either this year on your taxes or next year on your taxes. Come up with a plan to take full advantage of the tax laws that are in place so that you can save as much money as possible each year on your taxes and get the most benefit out of your business. As always, thank you for your support. Until next time, this is J.R. Lawhorn telling you to keep climbing the HVAC ladder.